In our investment outlook, BFI Insights, that we just released, we are taking a look at the year 2020 and what it might bring for investors. And the title basically of the investment update is the year ahead, kind of expect the best and prepare for the worst. And this might sound a little bit, over dramatically, but what we think really is that the year 2020 is, we're in a very different situation compared to early 2019. A year ago, investors were mainly talking about the central bank, specifically the Federal Reserve, and the expectation of several interest rate hikes that would come in 2019. And now, a year later, we are in a completely different situation. As we know, the world economy is actually in the process of slowing again. Central banks have reversed their policies again, so the normalization of interest rates and policies did not continue. In fact, we are already seeing central banks cutting interest rates and governments around the world getting ready to add fiscal stimulus. And while this is supporting financial markets on one hand, I think we also create here a situation where the outlook, specifically I think for the first half of 2020, is really uncertain because we're talking about, especially in equity market, that especially in the US, I want to say that valuations are really, really high, and we have very little earnings growth. In fact, the earnings growth in the US market is really only coming from a handful of companies, while a lot of other companies, out there are really struggling. And then looking at valuations and looking at the disappointing earnings growth, I think there is a strong point to be made that the overvaluation in an environment of slowing growth could potentially be create a very risky situation for investors. So the second half then, is probably going to be a little different, because I think in the second half of the year, there is a good chance that we're going to see a more positive development in the world economy, and with it, certainly, I think there are potentially attractive opportunities in the equity market again. Yeah, I think the risk, for 2020, I think you have to talk about two types of risks here. I mean, the first risk is obviously, as I just said, the very rich market valuations, and here specifically in the US. I mean, US equity markets are trading at such a rich premium. It's basically, this premium has never been at these extreme levels, that I think there's a valuation risk, here. So when people look at different types of investments and equity markets, they need to realize that the US market valuation is now so extreme and out of line with other markets that either the US market, is significantly overvalued, or most of the international markets are just way too cheap, And we certainly believe that the international markets are really, extremely cheap, and I think extremely attractive. The other risk I think we have to talk, and especially now here in the first couple of weeks in the new year, is the outbreak of the coronavirus, and that's something that potentially could lead to quite a significant problem. Now, in our recent investment update, the BFI Insights, we're talking about previous crises that are similar, like SARS, quite a long time ago, and we're looking at how did actually these virus outbreaks back then influence financial markets. And I think the bottom line is that with all of them, you see that there was never really a very significant impact on financial markets. But I think we have to also realize that with the coronavirus, we still don't know exactly what we're dealing with here. And I think there is certainly a possibility that this continues to spread. And in such a highly globalized world, it's basically impacting global supply and supply channels so much that there's potentially going to be a significantly larger impact on economies around the world, and that is certainly a risk that we're going to see a slowdown that is worse than people are currently expecting. So I think the outlook, that we have for 2020, if I, break that down into the various components of an asset allocation, I think we can certainly say that, the fixed income, bond investments are probably attractive, specifically in the US, because I think we're going to see a continued slide in yields. So when yields go down, obviously, the price of the bonds go up, and I think this is especially true for some of the longer duration, bonds. So there is certainly some attraction there. The rest of fixed income markets around the world probably a little bit less attractive, simply because most fixed income markets around the world don't really offer any meaningful returns or yields these days. Equity markets, I think it's a bit of a timing issue here. I think we're quite conservative and quite careful for the first half of the year. We certainly do believe that with the current valuations that we have, with the uncertainty that is there, with the slowdown in the economy, that there could potentially be a bit more negative volatility developing in the next few weeks, even with the potential for a sell-off in the market. But we would not expect this sell-off to be 20% plus. I mean, that maybe is 5 to 10%. But then I think the outlook for the rest of the year changes, because as we're starting to see the interest rate cuts, as we're starting to see a lot of fiscal stimulus coming through the system, this is potentially setting up the world economy for quite a bit of a bounce in the second half of the year. And because of that, I think that investors in the next few weeks or in the next few months might actually get a really, really attractive entry opportunity into different types of the equity market, very specifically international equities that look from a valuation point of view so much more attractive than US equities. And then also talking about alternative investments, more specifically, precious metals, I think it's clear. I mean, we've been seeing already quite, a strong upward trend in the precious metals. I think gold's been doing, really well. Other precious metals, such as palladium, which has basically been flying, lately, very extreme. But I think that the monetary policies and the continued liquidity injection into the financial system, I think, is also given a great support to these assets. So we definitely continue to be pretty positive on the precious metals, even though maybe short term the upside is a little bit limited. But we certainly feel that in this environment that's still quite an attractive investment. And I think also other investments, real estate, more specifically real estate investments in the international marketplace, I think highly attractive at the moment, because we have a situation where investors globally are really looking for all sorts of investments that are providing any meaningful level of income. And when the bond market is not giving investors this type of return, they will naturally starting to look at other asset classes. And for example, in the portfolios we build for our clients, we have quite a significant position in Asian specialty REITs, for example, and that has been, I think, a great place to be, and with all this capital flowing into these investments. So that's also a component of the asset allocation that we think is highly attractive. And maybe as a last note to that, I think one advice that we want to give, I think, investors in general is, while there's certainly opportunities, and I think especially for the second half of the year, you need to be very proactive. You need to have your risk management in place. So investors need to hedge their bets, especially for the next weeks and months. In our work, we normally do that by adding hedges in the portfolio, so that you know, if we get the worst case and you have indeed a 20-30% market correction, then there's a safety net in place, and I think that makes, you know, also investors feel much more comfortable. So we would highly recommend to have an active risk management in the portfolio for the time being.